Chaz, I've been speaking with our clients lately, and it seems like the profile of our assets is really beginning to change. And I think really the profile of Revolve as a firm is beginning to change. We're leveling up, and we're seeing some different assets now, more diverse, East Coast, New York. But I know we're taking down another portfolio coming soon, some really impressive assets. Tell me a little bit about that one. What are you thinking, and what should our clients know this upcoming portfolio?
You know, early, about 10 years ago, the 2011 through 2014 era, we were known predominantly as a lower valued buyer, investor. We were able to acquire that product for under market. We definitely saw a lot of the hedge funds looking at the $200,000 value and less, and we're not focusing on it. So we saw a definite arbitrage in the market where we can get into that arena. If you fast forward to where we are now in 21, the overall market value and the overall health of the asset is there now. And you're starting to see these investors and these banks shedding this stuff at a higher rate of return than they were 5 years ago. So yeah, you are starting to see a different overall looking asset, higher valued product that you still can foreclose on at a relatively discounted price to market value.
Yeah.
It's definitely changing.
Absolutely. So speaking about this, and while we're on this topic, when you buy from the banks, what are the valuation metrics that you use, other than BPO, because we know that's it's BPO for the houses that are underwater.
Yeah.
But what are the other valuation metrics you use? I know we kind of have a battle with our clients between unpaid balance and legal balance. Tell me why we buy off legal balance.
Today's market, in comparison to 10 years ago, homeowners were not sitting on equity. Values of homes were still declining at a rapid rate.
Yeah.
Today, values are inclining at a rapid rate. Sure, in 2022, people are projecting that will begin to flatten out, but in 21 and 20, it hasn't even unveiled itself that way. It's continuing to incline. So today, let's use an example of a $500,000 home, and let's just say the homeowner owes $300,000. So on the surface, it looks like they have $200,000 of equity. But when you lift up the hood and you actually underwrite what's happening in the homeowner, you see that they have not made a payment in 5 years. So you and I both know if we did a loan with each other and I lend you $300,000 and you didn't pay me for 5 years, you don't owe me just my $300,000 back.
Of course.
You owe me all back interest, fees, etc. Everything I've been advancing for you. So if you lift up the hood, you're starting to see the delta between the 300 and 500 being squeezed.
Are you legally entitled to that?
Fully entitled to it.
Of course.
You're the lender. You're the bank. If you've been advancing taxes, if you've been advancing insurance, if you've been advancing sewer and city liens to help keep all of these entities away from trying to collect to you as a lender, that's fully reimbursable and collectible as a bank.
Expenses that should be on the borrower.
Exactly, right? So you're now getting into the seat of the borrower, helping that property being lost to tax sale. You're advancing those taxes so the county at least receives their due part.
Yeah.
So it's great.
No, absolutely. And it's good to hear that, because as I deal with our clients, and we have these new clients coming from this awesome conference we're at, I think that's something we really have to set forward, is that pricing metric on legal balance. Of course, there could be, a rare cram down in the event of a bankruptcy.
Sure.
But, it doesn't happen too often, right? And that's why we just stick to that legal balance valuation metric for houses that have equity.
Mm-hmm.
Yeah. Chaz, as president of the firm, I know you control all of the assets that come in, and you're making those big decisions, because ultimately, I feel a firm is made up of the assets in the portfolio. That's really what it is, right? On top of course, the equitable partners, and most importantly, the managing partner, yourself. So within our portfolio, we're very heavy East Coast right now. New York, New Jersey, Pennsylvania. Although we do, of course, have assets in nearly all the states, including Hawaii. Tell me why lately you've been taking down a lot of New York, and why that's important to you, and where you think that market is headed.
A rule of thumb I learned years ago is that when folks are starting to run out of a market, that we should look to run into the market. And New York has been a suspect of investors being told to run out of the market for the last decade. It's namely due to the judicial status of the foreclosure in the state of New York. It also takes a lot longer to get to the real estate than it does like a state like Texas. But what we've been able to do over the last handful of trades here in 21 is we've been able to take on an East Coast presence, knowing that we're also able to acquire other states that are very more desirable for us. Now, what's come to light is that when you actually lift up the hood on this New York product, this New Jersey product, is that we acquired that stuff for well under market value. At the end of the day, we want to get that person to start performing again on their mortgage, but we know that it's occupied. We know that the sold comps in that market is very, very hot. I'm agnostic to it being in New Jersey, New York, or being in Seattle.
Yeah.
It's all going to be about market penetration and market liquidity. And we're starting to see that even though New York was one of the hardest hit states in COVID, and a lot of people actually moved their families from the state of New York into Florida or other states, I like to see the lesser competition when I'm starting to vie for these portfolios.
Yeah.
So that's why you're starting to see a little bit more of an East Coast kind of concentration coming into the portfolio.
Yeah, and I'll tell you, as an asset manager at the firm and helping to run the trade desk under you, when I saw those assets start to pour in, I was worried to start with. And then I, of course, asked you and learned why you're an expert in the industry, because you start to see that the prices in which we're picking up New York is so much cheaper because they're less desirable, that the big gains we're having in the first months of buying our portfolio is beginning to subsidize the rest of our purchase.
Big time.
Right? And I always say, one thing I'm learning in this industry is you're not defined by your best exits, but how you exit on your worst assets. Right?
Amen to that.
Yeah.
And I'm glad you brought that up, because first and foremost, let's look at New York again. The foreclosure timeline, if it went crystal perfect, and you started it in the month of January, if you expedited that foreclosure process, at a minimum, it's going to take you between 2 to 3 years to finalize that foreclosure process.
Absolutely.
Now, how do we justify locking up our capital for that long? We couldn't.
Yeah.
So when I look at a deal and I can see 70%, 80% of the foreclosure process has been ran, meaning it's already been completed and I need to take it over from that step to finish it out, I find the risk in that deal is a lot less than if I was only at 20% complete. So looking at some of those metrics is to find value of why I want to be on the East Coast. It's pretty straightforward.
Yeah,
You know?
Absolutely. And I know our new portfolio will be a little bit more diverse, and we're going to be taking down some southern assets,
Yep.
which, as we know, are a little bit more desirable from our clients. But in the future, we're trying to get them to be a little bit more acclimated to that East Coast environment, because there is money there. There is money.
Big time. Big time.
Yeah, absolutely. And then on top of that, talk about a little bit, which I love to share, the culture at Revolve, how you feel we've grown as a firm within the past year. I know I just came on 6 months ago, but things are changing a lot. We're starting to collaborate a lot more together. And what do you think we stand for as a firm?
I think that we stand for family and building relationships. I think that that's where it starts here for our culture. I've been talking a lot about yourself and the way that you go in for a transaction. It's not about the sale. Because I always tell you and I tell others that if the folks that acquire from us or make investments with us do not go out and make money, they won't be back. So you have to be concerned about their success and the wealth that they're creating so that you become a constant source for them. I've realized very early on in this business, I mean, I'm a sports guy, I used to play college football, and I realized without team camaraderie, without me leaning upon you, without you leaning upon me, how are we actually going to accomplish a goal at a faster rate of speed doing it alone? So I've realized that to weave that sort of thought process within our fabric of the company, it has to be about team camaraderie, it has to be about collaboration and communication, but most importantly, as you see, we're managing dozens of millions of dollars of this distressed real estate, but we're a very lean and small family in terms of a company. So I think that's crystal clear, because I think that comes across to everybody that works with us, whether you're a third-party company, whether you're a new incoming investor, you start realizing that we care about your success and what you do with the home so that you come back and we can now help you scale and grow the business.
Absolutely. My favorite thing to do is go to a client, call them up and say, hey, what happened with this asset? And just not to brag, and I'm going to also mention a few of our accomplishments recently. We just closed on a house in Jacksonville today where we had an 80% profit,
Yes.
Which is very exciting. And we also have another client here today. I asked him about an asset that he had bought, I believe it was 4 months ago, and he had gotten paid off at sale, legal balance of $190,000. He purchased the asset for $100,000 plus $3,000 extra in foreclosure costs.
Yeah.
Yeah.
So we thrive on these stories.
Of course.
It's so funny because you'll tell another seller like we are about that success.
Yeah.
And the minute they'll start joking and say, well, we need to charge him more next time.
Yeah, of course.
And for me, I want to see that our folks are profitable, right?
Yeah.
We know that we have a mark for every property we acquire. If that mark is hit, right, and they can go out and hit a home run, that's the whole beautiful part of this business.
And I feel it myself, Chaz. You had just recently allowed me to buy a note from Revolve, and you were very happy when I turned around and made some money on it, and the plan that I had, which you are genuinely concerned about the success of the investors post-purchase. And another thing I would like to mention about Revolve is I had a client come to me today and say, yeah, I'm having some trouble with this asset in bankruptcy and they're no longer paying. And I said, so what's the issue? What can I help you with? she had asked a few questions, legal questions. And I said, well, why haven't you come back to Revolve? I'd be more than happy to help you and speak to you about what's going on. Put you in touch with our fantastic in-house counsel, Dan Singer. And she had mentioned, well, I don't want to bother you guys, and I don't want to lose, let's say, my credibility with you by coming back to you and bothering you with stuff. I said, that is the opposite of how we operate. If you ever have an issue with an asset, any questions, buying an asset from us is not only basically purchasing the note itself, but also you're purchasing a team. You're becoming part of a family and an environment. So that's one thing I love about us. I love working for the firm, and a culture that you have demanded when I came in here, and something that I am now supporting.
Love that.
Yeah. Another thing I'd like to mention, Chaz, I'm starting to see the market. Being on the trade desk, I have a lot of exposure to exactly the market as a whole and what people are paying for certain assets.
Right.
As we start to move up in our average value at Revolve, typically we're dealing with assets in the more, just below 100,000 to middle of 100,000. Now we're starting to move up to the $300,000 range, $400,000 range. We even have an asset worth $1.8 million on the books, and we're starting to garner prices in the 70s of BPO or legal balance, whatever's lower. Can you explain to me real quick why you think that's happening, and how can we justify that?
Going back to us being known in the market as a lower valued investor, it's hard to find real market value in a $70,000 house, rural USA. Let's take that same example on a $700,000 house in Indianapolis. I think investors know that that's a rentable market, it's a main market, and if I had to foreclose and get that real estate back, I can pay a little bit more of a premium because of where the house is located. So knowing that we've stepped up in our property values and we're starting to see that we are actively pushing the foreclosure much further down the football field than where it was historically, we're starting to see the garnishment of higher price points coming through our investors. Now it's because we have in-house counsel, we work intimately with our servicer, so we're not just sitting on our hands when we buy a portfolio of assets. We're taking them from a 0% status to a 50% to 100% as quick as we can. If we're able to sell that product before it gets to the 100% status, we do want to sell it to you for a discount, but we can't sell it to you for well under market value. And you're starting to see that the market understands, look, if you can still get properties today, in today's market where HPA, home price appreciation, is at an all-time high, and you can still acquire a product for under market value, that's a steal. Yeah. So when you hear 70%, 65%, 75% of the market value, you couldn't go to the auction steps and buy that product for that cheap. So we're still an under market value seller, and that's why I think the investors are starting to kind of really play into that.
Yeah, and if you look at it in a way, and let's say you were to realize that true market value, which is when you buy an asset, we're talking about a market value is BPO as is value, and you buy an asset for, let's say, 70 cents on the dollar and sell it for 30 cents, and realize that arbitrage between 70 cents and a dollar.
Yeah,
right?
yeah.
That's 3 over 7. You're looking at between 40 and 50%, right?
You know what I get reminded of all the time, though, Frank, is that when you and I would sell that asset for 70%, that's 70% of as is value. No rehab,
exactly.
No fix and flip would go into this property. And I think you and I both know, we call it an ARV, an after repaired value. Yeah. What was your acquisition cost on the after repaired value?
Yes.
That's a metrics that I want to make sure the audience definitely looks at, because sure, I'm selling you a discount on as is, but I'm expecting you guys, once you get the asset through foreclosure, you're going to put a little bit of lipstick on these assets to be able to help you have liquidity and sell them quickly.
Absolutely, and that's one thing I like to reiterate to our clients and emphasize is that when you do due diligence at Revolve, we have so many assets, and the assets that we buy, we go off BPOs that we give you. It's not like we have one BPO and we formulate a new one with a higher price. Those are the BPOs we went off of.
Big time.
So it's important to verify that as a client, and we expect people to do that because we never want to be in the position of misleading anybody.
Big time.
Due diligence is due diligence, and we do our best to be as transparent as possible, which we have been. We rarely have any complaints where it can be tracked back to us misleading someone. Any complaints is really just someone's lack of due diligence on their end.
Yep, lack of knowledge. And that's where we can help out. I think that I talk to a lot of our clients about infrastructure.
Yeah.
And it's really not just about your money. It's about who is your team and your vendor team. Who's helping you get boots on the ground that you may not have resources in. Talk about valuation, title, tax, reading through servicing comments, understanding the market in terms of how quick our house is selling in that market. That all comes from having resources and teams, and all stuff you can get here at Revolve.
Yeah, absolutely. So Chaz, I appreciate it. Thank you for the time. You were fantastic. Thanks for
Hey.
explaining everything, and let's get back to work.
Let's
right?
do it. Let's do
Yeah.
it.